Welcome back to XRP Insider, your trusted source for the latest XRP news, Ripple updates, crypto market moves, and everything shaping the future of digital assets. Today we're breaking down why XRP suddenly lost momentum after a major regulatory rally, why traders are suddenly nervous again, and how rising rate fears and macro pressure may be putting the brakes on Ripple's recent breakout attempt. XRP had traders excited after the Digital Asset Market Clarity Act advanced in Washington. But within hours, the market mood shifted completely. What looked like the beginning of a powerful continuation rally suddenly turned into another sharp reminder that macroeconomics still controls the crypto market more than many investors want to admit. XRP surged toward the $1.54 to $1.55 range, but by Friday morning, the token had fallen back near $1.44 as bond yields climbed and expectations for Federal Reserve rate cuts began fading quickly. Right now, investors are trying to figure out whether this is simply a temporary pullback before another breakout higher, or the beginning of a much deeper correction for Ripple and the broader crypto market. XRP traders initially reacted positively after lawmakers pushed forward the Digital Asset Market Clarity Act of 2025, which many in the crypto industry see as one of the most important regulatory developments in years. The Senate Banking Committee voted 15-9 to move the bill forward, creating optimism that the United States may finally be moving toward a more structured crypto framework. That headline alone was enough to inject fresh energy into XRP, because Ripple has spent years battling regulatory uncertainty. For a brief moment, it looked like the market finally had the catalyst it needed. XRP jumped aggressively and touched a two-month high near $1.55, creating strong bullish momentum across social media and futures markets. Traders suddenly started talking about a move toward $1.70 and even higher levels if the momentum continued. But as quickly as the excitement arrived, the market mood changed once investors turned their attention back to inflation fears, Treasury yields, and the Federal Reserve's next move. The regulatory optimism remained important, but macroeconomic pressure became the stronger force driving price action. According to market data, XRP slipped roughly 0.64% over the last 24 hours after failing to maintain its breakout momentum. Bybit data showed the token moving between a high close to $1.54 and a low near $1.43 during the session, highlighting the intense volatility traders experienced. The move lower came as investors began rotating out of risk assets broadly, not just XRP. This is important because many retail traders immediately assume every XRP decline must be connected to Ripple itself or another lawsuit headline. But today's pullback appears to be tied more closely to the broader macro environment. Bitcoin also struggled, hovering near $79,000, while Ethereum slipped toward the $2,200 range. The weakness across crypto markets reflected a growing concern among traders that interest rates could remain elevated for longer than previously expected. When yields rise and rate cut expectations fade, speculative assets like cryptocurrencies often face selling pressure because investors become more cautious about risk exposure. XRP simply got caught in the middle of that larger macro shift happening across global financial markets. One of the biggest drivers behind today's pressure came from the bond market. Reuters reported that U.S. Treasury yields climbed to their highest levels in about a year, as traders started pricing in the possibility that the Federal Reserve may need to keep policy tighter for longer. Concerns surrounding inflation have intensified recently, especially because of energy price uncertainty connected to geopolitical tensions involving Iran. Rising oil prices can fuel inflation across the economy, and if inflation remains stubbornly high, the Fed could delay rate cuts or even consider additional tightening. That possibility immediately changes investor behavior across markets. Daniel Von Allen, a senior macro strategist at global data TS Lombard, described the current environment as a much more volatile inflation climate, and investors clearly reacted to those warnings. Higher yields make safer investments like bonds more attractive relative to speculative assets such as crypto. That shift in sentiment often creates rapid downside pressure in digital assets because traders begin reducing leverage and cutting risk positions aggressively once they fear tighter monetary conditions ahead. The pressure from rising yields wasn't limited to the United States alone. Analysts across multiple financial institutions echoed concerns that global yields are reaching levels capable of hurting investor sentiment broadly. Eugene Liao, senior rate strategist at DBS, noted that yields have climbed high enough to negatively affect market confidence, and crypto traders clearly felt that impact today. Markets had been hoping inflation would continue cooling throughout 2026, allowing the Federal Reserve to begin easing monetary policy sooner. Instead, the latest developments are forcing investors to reconsider that entire narrative. When the market starts repricing interest rate expectations, crypto often becomes one of the first sectors to experience volatility because of how heavily sentiment and liquidity influence price movements. XRP had already rallied sharply into the Clarity Act headlines, meaning many traders were sitting on short-term profits. Once macro pressure intensified, those traders quickly began locking in gains, adding additional selling pressure to the token. The result was a sudden reversal that erased much of the excitement generated by the regulatory news just hours earlier. Derivatives markets also played a massive role in amplifying XRP's volatility during this move. CoinGlass data showed XRP futures trading volume reaching approximately $6.83 billion over the last 24 hours, while spot market volume came in around $1.46 billion. Open interest in XRP futures stood near $2.96 billion, revealing just how much leveraged positioning had built up during the rally. Whenever leverage becomes crowded in one direction, the market becomes vulnerable to sharp liquidations once momentum shifts. That's exactly what appears to have happened here. XRP futures liquidations reportedly totaled around $17.1 million, as traders who were aggressively betting on further upside suddenly got squeezed when the token failed to hold above breakout levels. In crypto markets, leveraged traders can accelerate moves dramatically because forced liquidations create automatic buying or selling pressure, depending on which side gets caught off guard. Today, bullish traders experienced that pain firsthand, as the market quickly reversed after the initial regulatory excitement faded and macro fears took over the narrative again. CoinDesk also highlighted that XRP had already surged aggressively before the sell-off began, meaning the token was particularly vulnerable to profit-taking once momentum slowed down. Markets rarely move in a straight line, especially after sharp rallies fueled by news catalysts. XRP touching a two-month high near $1.55 attracted momentum traders hoping for a continued breakout. But once the token started slipping back toward $1.46, confidence weakened quickly. That triggered a cascade effect where traders who entered late began rushing for exits simultaneously. Crypto markets are heavily driven by psychology, and sentiment can change within minutes when momentum disappears. XRP's failure to immediately continue higher after the Clarity Act vote likely made some traders nervous that the rally had become overextended in the short term. Once Treasury yields continued climbing and broader market risk appetite weakened, the bullish momentum completely lost steam. Instead of focusing on Ripple's regulatory progress, traders suddenly became obsessed with inflation risks, interest rates, and fears that liquidity conditions may tighten further across global markets. Macro strategists across traditional finance have also been warning investors that the current environment may become increasingly difficult for risk assets moving forward. Tim Graff, head of macro strategy for EMEA at State Street Markets, suggested that the combination of elevated inflation and rising rate market pressure could trigger broader pullbacks across markets. ING strategist Patrick Garvey similarly emphasized that inflation remains front and center in investor thinking right now. Those concerns matter because crypto assets thrive in environments where liquidity is abundant and borrowing costs are lower. When investors believe rates will stay elevated, speculative markets often struggle to maintain strong momentum. XRP traders are now caught between two competing narratives. On one side, regulation appears to be improving significantly for the crypto industry, which should theoretically benefit Ripple in the long run. On the other side, worsening macro conditions threaten to overpower those positive developments in the short term. Right now, the market seems more focused on macro fears than regulatory optimism, which explains why XRP lost momentum despite what many considered bullish legislative news. The Federal Reserve itself has done little to calm market fears recently. Kansas City Fed President Jeffrey Schmid reportedly described continued inflation as the top risk facing the economy, signaling a notably hawkish tone, even though he is not a voting member this year. Comments like that matter because traders closely monitor every statement from Federal Reserve officials for clues about future monetary policy. The market had previously expected multiple rate cuts during 2026, but those expectations are now being pushed further into the future. As rate cut hopes fade, the pressure on crypto markets increases because investors realize liquidity conditions may remain tighter for much longer than anticipated. XRP's decline today reflects that shift in expectations very clearly. The token wasn't reacting to a Ripple scandal or negative lawsuit development. Instead, it was responding to a market suddenly worried that inflation could stay sticky and that the Federal Reserve may not deliver the easing cycle investors had been counting on throughout the year. Major financial institutions are also adjusting their forecasts to reflect this changing environment. UBS Global Wealth Management reportedly delayed its expectations for Federal Reserve rate cuts, now predicting cuts in December 2026 and March 2027, instead of earlier projections for September and December 2026. That shift reflects growing concerns that inflation pressures and labor market strength could force policymakers to remain cautious for longer. According to Reuters, CME FedWatch data showed an 87.4% probability that the Fed skips a September rate cut entirely. Those probabilities matter because financial markets price assets based on expectations about future liquidity conditions. If investors believe rates will remain elevated, appetite for speculative investments tends to weaken. XRP's recent rally depended heavily on optimism and momentum, but that momentum became difficult to sustain once the market started aggressively repricing interest rate expectations. Traders who were previously comfortable taking leveraged positions suddenly became much more defensive, contributing to the rapid cooling in XRP's price action after its breakout attempt stalled near the $1.55 level. Prediction markets are also painting a cautious picture for the months ahead. On Polymarket, traders reportedly placed a 67% probability on the Federal Reserve delivering 0 rate cuts during 2026, making that the dominant expectation among participants. Odds for a single rate cut stood significantly lower, while another prediction market even assigned meaningful probability to a potential rate hike next year. Those numbers show just how dramatically investor expectations have shifted recently. Only weeks ago, many traders expected easier monetary policy to support risk assets throughout the second half of the year. Now the conversation has completely changed. Investors are debating whether inflation could re-accelerate and force the Federal Reserve into maintaining restrictive conditions longer than anticipated. That uncertainty creates a difficult environment for crypto assets because digital currencies often depend heavily on positive sentiment and abundant liquidity. XRP's inability to maintain its rally despite strong regulatory headlines suggests traders are currently prioritizing macroeconomic risk management over bullish crypto narratives, at least in the short term. Kalshi prediction market data also reflected uncertainty surrounding XRP's near-term direction. Traders reportedly assigned around a 30% probability that XRP rises above $1.60 during May, while giving similar odds that the token falls below $1.30 during the same period. That balanced positioning shows how divided the market currently is. Some investors still believe regulatory clarity and improving sentiment around Ripple could drive another breakout attempt. Others fear that worsening macro conditions and fading rate cut hopes could trigger deeper downside pressure. Right now, neither side appears fully convinced, which explains the volatile and indecisive price action traders are witnessing. XRP continues hovering near critical support levels as investors wait for stronger signals from both policymakers and the broader economy. If Treasury yields continue climbing and inflation fears intensify further, crypto markets may struggle to regain bullish momentum. But if yields stabilize and sentiment improves, XRP could still have room to recover from today's pullback and potentially challenge resistance levels once again. Despite today's weakness, many analysts still view the regulatory developments surrounding the Clarity Act as fundamentally positive for the crypto industry overall. Reuters noted that the proposed legislation would allow certain crypto firms to raise substantial amounts of capital annually without needing full SEC registration requirements. For many in the industry, that represents a major step toward creating a more functional and innovation-friendly regulatory environment in the United States. Ripple supporters have long argued that unclear regulation has held back broader institutional adoption of XRP and other digital assets. So even though the market reacted negatively today, the longer-term implications of the legislation could still prove highly beneficial. The issue is that macro conditions currently dominate trader psychology more than regulatory optimism. Investors may appreciate the positive legislative progress while simultaneously reducing exposure because they fear higher rates and tighter liquidity. Both narratives can exist at the same time, which is exactly what appears to be happening across crypto markets right now. The bearish scenario for XRP is becoming increasingly straightforward in the eyes of many traders. If inflation concerns continue worsening and Treasury yields keep rising, risk appetite across financial markets may weaken further. Under that scenario, leveraged crypto positions could continue unwinding, placing additional pressure on XRP and other major digital assets. The key support zone many traders are watching now sits roughly between $1.40 and $1.45, which previously acted as a breakout area during the recent rally. If XRP loses that range decisively, bearish momentum could accelerate quickly as stop losses and liquidations begin stacking up underneath support levels. At the same time, investors remain worried that fading optimism around Federal Reserve rate cuts could continue weighing on sentiment for weeks ahead. In that environment, even strong regulatory developments might struggle to generate sustained rallies because macro fears would overshadow crypto-specific catalysts. That possibility explains why many traders are approaching the current market with much more caution despite Ripple's positive legislative momentum. At the same time, bulls argue that today's pullback could simply be a temporary sell-the-news reaction rather than the start of a larger collapse. XRP had rallied aggressively ahead of the Senate vote, so some degree of profit-taking was always likely once the news became official. If Treasury yields stabilize and inflation fears cool down, crypto markets could quickly regain momentum. XRP supporters also point out that Ripple continues benefiting from improving legal and regulatory conditions compared to previous years when uncertainty dominated the narrative entirely. In that scenario, today's dip may eventually look like a healthy reset before another attempt higher. Crypto markets often experience sharp corrections during broader uptrends, especially after rapid news-driven rallies. The challenge for traders now is determining whether this move lower represents normal consolidation or the beginning of a more sustained shift in market sentiment. Until macro conditions become clearer, volatility will likely remain elevated across the entire digital asset market, including XRP. What makes this moment especially important is that XRP's recent rally was not driven purely by hype. There were genuine catalysts supporting bullish sentiment, particularly the progress surrounding crypto regulation in Washington. However, the broader market environment remains incredibly sensitive to interest rates, inflation expectations, and central bank policy. That means even fundamentally positive news can struggle to sustain momentum when macro conditions turn negative. Investors are now learning once again that crypto does not operate in isolation from the rest of the financial system. Treasury yields, Federal Reserve policy, geopolitical tensions, and inflation data all continue shaping the direction of digital assets just as much as blockchain developments or regulatory announcements. XRP's price action over the last 24 hours perfectly demonstrates how quickly market focus can shift from optimism to caution once macroeconomic risks begin intensifying again. At the end of the day, today's XRP decline was not caused by a new Ripple controversy, a surprise lawsuit development, or a sudden collapse in confidence surrounding the project itself. The token simply lost momentum after a powerful Clarity Act rally collided with rising bond yields, fading rate cut expectations, and a broader pullback across risk assets. Futures traders added fuel to the volatility through heavy leverage and liquidations, while macro fears ultimately overshadowed the positive regulatory headlines that initially drove the rally higher. Now all eyes remain on Treasury yields, inflation data, and the Federal Reserve, because those factors may determine whether XRP stabilizes and rebounds or faces additional downside pressure in the sessions ahead. One thing is clear, though. The battle between regulatory optimism and macroeconomic fear is now shaping the entire crypto market, and XRP currently sits right at the center of that fight.